Alright everybody, welcome back. Today we're going to be going over how to roll your call options if your call option is in the money and you still want to hold on to the stock. So in previous videos we went over, what a call option is, how to, sell covered calls to generate income from stocks that you already own. This video is going to be more about what to do if those options you sold are now in the money, so the price of the stock is currently trading above the strike price and we're getting pretty close to the expiration date. If we're far out from the expiration date, I typically will not roll my options even if they're in the money, unless we have something like a dividend coming up, and then I will take that into consideration. But for the sake of this video, we're not going to take any dividend dates, ex-dividend dates coming up into consideration for when to roll an option. So we're going to give an example of a stock I have right now that's currently have options that are in the money, and I'm going to show you an example of how you can roll those options to a later date and at a higher strike price and still generate a credit. Um, Now I'm actually not going to do this trade today, but I'm going to set it up and show you what the credit would be for that trade. I'm just not ready to do the trade yet, because we are too far away from the actual expiration date. Um, so the stock we're going over today is OHI. I own them in my retirement account. It's a REIT. Definitely a good company. Definitely check them out. Maybe I'll do a video on that company at some point. I've owned them for probably, give or take, 8, 9, 10 years. They pay an amazing dividend. But that's not what this video is about. It's about call options today and rolling them. So I currently own the $36 strike price on this stock. Or I currently have the contracts for it. So I sold them 5 contracts at the $36 strike price. You can see on the screen here that the stock currently trading at 38.29. I definitely don't want to lose this stock. This contract I actually just recently rolled out and up to this date, and this strike price, I originally had the $35 ones that expired in March, and we were getting pretty close to it, and definitely should have made a video when I did that, but I just didn't get around to it at the time. So I'm going to set up a trade of what to do, how you would roll that out. So 2 ways. I'm going to show you the easy way first. That way you can just see the concept of how you will generate a credit even though the contract is still in the money. So E-Trade, and I'm sure a lot of other brokers have good tools like this too, but obviously I only use E-Trade, so we're going to do it that way. So here's all my entire portfolio. We're just going to go right down to where the call is, which is right here. And so we just click on it and we click roll. So here it brings up the order screen, and at the same time we're just going to pop back to the options thing. So here we can see that the contract, like the order's already set up. It's setting up to close out our 5 contracts for our $36 one. Say position -5, buying 5, but at the same transaction, we're going to sell 5 contracts. So the same amount of contracts as I'm buying, I'm selling at a later expiration date, and it just defaults to the same strike price. But you can see just that alone is going to generate 50 cents per contract, so $250 for the 5 contracts. So that's one way you can do it. If you feel that the stock price is going to go back below, in this case $36, you can just do that to generate the most income possible. But it's definitely a good company, and I'm looking to get a higher strike price when the time comes. Something like 37, 38, or 39 long term. So we can adjust the strike price to 37. So currently, given, and this is all real-time data because, like I said, the market's open, so we're seeing this all in real time. So if we did the 37 strike price in September, it's going to break even, so it's going to be 0-0. So you are going to get the higher strike price, which that alone is worth money, because because you always have to think that the stock is going to get called away, is going to get bought away. So that alone is going to give me another dollar per share. So dollar times 500 shares is $500 more just by doing that alone. It's not going to generate any credit for me right now, given the specific price. I mean, you can put a limit order in, a limit credit, and then put in whatever you at least want. Like if you want at least 10 cents, but it's going to get a little harder to get filled. I mean, because you can see the spreads -30 to 30. So I mean, the midpoint's at 0. You could probably put the order in and have a chance of getting filled. But I'm just looking at the midpoint for this example. We're not going to get into too into pricing out things and different things. So anyway, so as we went over in the previous video, we know what theta is. So theta obviously is your time decay, and so the further out you go in time, the more the stock is worth. I mean, the more the contract is worth just in general, because there's more time, and time is money. So if you still wanted to sell the 37 right now, and obviously the midpoint's at 0, what you could do is go out an expiration and extend the expiration. So you can do the January 2022s, and you can see that credit, it's at 65. So if you wanted to, you could sell that right now and get about $325. I mean, you could see if we can get the 40 to the next one on the strike price. The further you go in time, they don't have as many strike prices, so you can see that's why there's, it goes from 30 to 32, 35, 37, skipping around. But like if you want the $40 one, we're getting a debit now, so we do not want to do that. I mean, you could do that. I mean, I'm just not a fan of it, so I don't do that. So I mean, if you did really want to do the $40 one, you could even extend the term out more, and you could see how the way that the whole concept works. So why I'm not actually doing this trade now, and as you get more into options trading, specifically call options, covered calls, and so on, it would be better to do this trade. So if the stock is still above $36 when it comes close to June, so we'll say like mid to late May, I'll start looking into rolling this options, because we are pretty close to the expiration. Because as I was saying in a previous video, the decrease in theta increases the closer you get to the expiration date. So the closer you are to the expiration date, the theta is going down faster and faster each day, which means that the option price is still going down faster at the closer expiration time than the later expiration time. So, to get more into it, in the June ones, right? So it's trading between 340 and 370 right now. So the contract price is still more than what the stock is in the money. So the stock is currently in the money $2.32, which means the stock price is trading $2.32 above my contract price. So $2.32. But the contract is trading at, above 340. What that means is this contract is still going to decrease in price according to theta. So theta is showing that the price is going down to $1.15 a day still. But we look at the ones in September for that same strike price, they're going down less than $1 a day. So as these go down faster, it'll be easier to get a credit the closer we are to the expiration date. So this is 109 days away from expiration, and the September ones are 200 days away. As we get closer to the June expiration, the theta spread between the June and the September is going to increase even more, which will then allow you to have a better chance to get a credit spread when it comes to rolling your options. So when it comes to buying back the June options and then selling the September options at a higher strike price. And that will let you still generate a credit, increase in the strike price, and extend in the term. Even if you increase the strike price and it's still in the money, you definitely want to get a good good term on that, and constantly just increase it. And this is how you can hold on to the options forever. So I know a lot of people don't sell call options on their stocks because they don't want them to get called away, but this is how you prevent them from being called away. So I mean, they still have a chance to get called away. So if you don't want to take any risk of them being called away, obviously selling covered calls options is not for you. But for those who are looking for that little extra income on the stock they already own, there's no additional collateral required to do this strategy. That's why typically you only need a level one options trading approval for that. And there's 4 options level trading. And selling covered calls is level 1, and I believe that's the only thing in level 1 trading. So because it's 100% collateral, you have the stock, you could sell the contracts on the stock that you already own. So that is basically how you would roll a call to hold on to the stock forever for contracts that are in the money. It's a pretty simple concept once you get into it and once you understand it. So that, I mean, that was the easy way to do it on the E-Trade platform. If you just click on the roll button, it basically sets it up for you, and you can adjust the expiration date and the strike price pretty easily. I mean, if you just want to do it from the options chain screen itself, I mean, you have 5 contracts or however many contracts you have, so you can simply just put an order in to buy them 5 back. Then you want to add 5 to sell, and then I mean, we're basically up on the same screen. So now you just put whatever expiration date you want and the strike price, and then you go from there. So for those who use a platform that don't have like that easy button where you just click roll and it sets it up the order for you, and then you just edit it. That's how you would set it up manually. So it's definitely a good way to do it. I mean, you can then compare prices. If you don't want to sit there and play with the order screen, you can compare prices yourself. So, and you can look at the $36. They're trading between 340 and 370. So if you want to generate a credit when it comes to rolling out your options, you have to compare the prices of ones that are higher. So you can see that the 37s are actually trading at the exact same price between 340 and 370, the ones that expire in September. That's why we were seeing a net debit, a net credit of 0. It was even. I mean, sometimes you can get price improvement and then still get that fill with the credit, but that's that you're taking a risk doing that stuff. But you can see that we go to the next strike price of $38. It's between $295 and $320. So if you want that $38 strike price, you have to look at extending the term to increase the money. So to get rid of the Septembers, you pull up the Januaries, and I mean, you can see you can get to 37s between 4 and 440. And then as I was saying earlier, they don't have all the strike prices when you get further out in time. So the $40 ones are between 290 and 310. So they're below. So you're not going to get a credit between that. So I mean, if you do want the credit, you have to then look further out. And I mean, there's not much activity when it's 690 days out. So the spreads are really, really big. I mean, you do have a chance to get a credit because I mean that bid's obviously pretty low. But it's just so far out. There's not as much people in the market, so you do get those massive spreads. So that's what makes it a little bit harder to roll them super far out. That's why, again, I usually only roll them out when it's a month or so before, when we're getting close to that, or if there's a dividend involved, and I'll go over that concept in a later video because it does add a little bit more complexity to the issue, but not too much, and it's a pretty simple concept to understand. But we'll go over that in another video. But yeah, I mean, that's pretty much how you do it. So hopefully you guys are liking the videos on the call options and how to generate additional income from stocks that you already own. So feel free to give the video a like. Definitely helps the channel out a lot. And then definitely hit that subscribe button because it definitely would appreciate that. We have lots of option videos coming out in the future, and as well as other investment videos. I mean, the channel already has real estate videos up. We'll be talking other stock videos, futures, forex, all that stuff. Anything to do with investments, finance, definitely on the channel. So hit subscribe button. Check out our Discord. We do have a lot of channels on there about everything we talk about in our videos as well. So until next time, guys, we'll see you then.